All right. Hello, everyone. Thanks for joining. We are going to start in a few minutes as we have folks getting in on here. Oh, and perfect. There's Derek. Morning, Derek.
Hello.
Or I guess afternoon at this point. Seeing some more folks coming in. A few more seconds. All right. Okay. Well, welcome everyone to our first user webinar at Income Lab of the year. Happy New Year to our existing users. To our new users, welcome to our monthly webinars. We are excited to bring our two experts to the panel, Justin, our co-founder, and Derek Tharp, our senior advisor and head practitioner, I'd say, who always gives us great feedback on how advisors are using and talking about Income Lab. With our webinar this month, we are going to take a deep dive into our analysis methods, so historical analysis, traditional Monte Carlo, regime-based Monte Carlo, and really help users have a better understanding of what those are and how that really plays into Income Lab. For those of you who this is your first webinar, we will also hold a Q&A session at the end. So you'll see in our Zoom webinar space here that there's a section for Q&A. Go ahead and drop any of your questions into this section. You'll also be able to like other people's questions. So if someone has a question that you also want answered, you can like it and move it up in the queue. And then at the end of the presentation, I will kind of just work through the queue and help answer any questions. Outside of that, we will also record the webinar. So after tomorrow, if you want to kind of rewatch the webinar, you'll also be able to do so as well. Outside of that, guys, welcome. I will turn it over, Justin, to you and Derek, and I'll be back when for Q&A.
Okay, great. Thanks, and Happy New Year, everybody. Share my screen here. So today's webinar, and for those of you who are new, usually we try to do about half an hour of presentation and then open it up for Q&A for up to half an hour. So today's topic, it really dives into some of the background or some of the underlying parts of the Income Lab platform. And so some of what we'll talk about today, and I think maybe even Derek's commentary on this will be how much of this to kind of expose to clients, how to talk about it and things like that. But a lot of it is really about kind of your settings, your choices in developing plans, and so on. So we call it "What's your model of the world?" Because really, let me make sure. Yep. We want to think about this as when we're building a plan, what kinds of inputs and analytics go into it, right? So our goal is to get this retirement income plan. Our goal is to get, ideas, measurements, concepts, pictures that we can use to communicate with clients and to guide them through retirement or pre-retirement. But a lot goes into that, right? So we have what I'm calling household particulars, which is really all of the special things about a household. It could be their age, their longevity preferences, their risk tolerance, the types of accounts they have, how much money, how it's invested, when they're taking Social Security, all of those particulars. But we also need these models, right? These other things about how we think the world works. So I've divided them here into your market model, your economic model, your actuarial model, and so on, right? And I keep saying that word model because a really important thing to remember in any kind of modeling is our model of the world is not the world, right? So quick art history lesson here. Probably many of you have seen this before, right? So this is Rene Magritte. This is not a pipe. It's a representation of a pipe, right? So you can't pack this with tobacco. Same thing goes for our models. That doesn't mean we're gonna sort of give up, throw our hands up on modeling the world. No, we want to be as accurate, as realistic as possible, but there is simply no getting away from this problem, right? That we can't predict the future, and that we're always making decisions and plans within a model of the world, right? So this fact has actually, it's very relevant, right? This is not just some kind of weird esoteric academic concept. Model risk is very real. There has been a lot written about the 2008-2009 financial crisis, talking about model risk, right? It's this risk of loss resulting from insufficiently accurate models when they're used to make decisions, right? And we can kind of think about this for retirement income planning as well as the risk of an adverse outcome due to significant differences between what we're modeling and the actual outcomes. And I would say there's two really important things here. One is you actually have to have a risk of an adverse outcome, right? So there has to be some so what about it for there to be real risk. And the other is that there has to be something where we're actually using this to make decisions, right? Where it's sort of somewhat in our control. So for the more general case and the example I have of the financial crisis, again, lots of articles about kind of mistakes in modeling credit derivatives, sort of assuming things couldn't be as they were. For our purposes in retirement income planning, it might be something like using capital market assumptions that are significantly higher or lower, or maybe return inflation assumptions that are higher or lower than the household might actually experience. But the real takeaway is all models have model risk. So there's really no way to completely get rid of model risk. So that's kind of the overarching kind of sort of philosophical underpinnings of this discussion. Here are some ways that you could, some kind of statistical approaches that you could use for your economic model or your market model. And by economic model here, I'm mostly talking about inflation. And for market, we're talking about investment returns. You could use straight line appreciation. This is still commonly used anytime you're using spreadsheets. It's sort of the the Excel present value, future value, payment rate sorts of calculations, or it's your financial calculator. Traditional Monte Carlo, and then in Income Lab, we also have regime-based Monte Carlo and historical. It's actually interesting. So straight line appreciation, it's pretty easy to, look down on this, and I think there are reasons to. But even in Income Lab, we use straight line appreciation where we have to. Anywhere where something more complex or more realistic would be confusing or misleading. So here's an example. If you're looking at the income sourcing chart in the nominal view, so including inflation, so looking at future dollars, well, we have to show something, right? And so we use a straight line appreciation for inflation in this case. Using anything else would be very confusing. So what if we used, varying inflation, which is what we use in every other part of the application where we can? Well, you might see this line kind of going up and down. Maybe there's deflation some years. That's just unnecessarily complex to explain to a client, right? So it's very reasonable to use straight line appreciation in certain cases. But obviously, straight line appreciation for households that actually have investments would be problematic, because we know that investment returns can vary and are not identical every year. And so that's really where more complex analysis types came into financial planning, most famously Monte Carlo approaches. And Income Lab offers both historical and Monte Carlo, what we call analysis types. And this is one of the places where you may want to explore what approach you prefer to use. So, we have maybe personal opinions, but we certainly don't have kind of an overall opinion on which one you should use. There are pluses and minuses that we're going to go over here. So Monte Carlo is just a way of kind of creating return sequences, lots of different possible approaches. We use 1,000 scenarios in our Monte Carlo analyses in order to show that, look, returns could vary. year by year, month by month. So in Income Lab, we do things monthly whenever we can. And so we're talking about monthly returns here. On the Monte Carlo side, we offer both a traditional Monte Carlo, which is similar to what you'd find in a lot of other applications where you're using one set of capital market assumptions for all the months in the plan. And we have a regime-based Monte Carlo that uses two sets of capital market assumptions. One for the first number of years, and that's a setting that you can choose. We use, our default is for the first 10 years, and the other set for the remainder of the plan, however long that is. If the plan is less than 10 years, in that case, you wouldn't be using those at all. If it were 30 years, it'd be for the 20 years that follow the first 10. For historical analysis, we use index return sequences. So actual inflation adjusted return sequences, and actual inflation sequences as well, for the model. Let's take that second one first, because I think there's a lot to talk about here, because there aren't many applications that let you use historical analysis. So I think it's worth discussing some things about it. So as with any kind of modeling, there's advantages and disadvantages. Probably the main advantages are we're only going to be looking at scenarios we know can actually happen because they have happened. So I sometimes joke that the term historical data is redundant. The only kind of data we have is historical data. Another positive thing here is, people will sometimes wring their hands about Monte Carlo analysis because it's really hard to capture all of the complexity of how investment returns really behave. So the example that I like to use here is, people joke that in times of market turmoil, the only thing that goes up is correlations. So when you're doing Monte Carlo analysis, you typically provide one set of correlations among asset classes, but those correlations are the same no matter what. When you use historical analysis, you're able to include in that range of possible scenarios where correlations went up, right? Where correlations themselves varied, or where standard deviations varied. So these kind of second and third level statistics they're just baked into historical analysis, but they would be very difficult to put in Monte Carlo analysis, and in practice, they never are in financial planning. Another advantage, which we're going to talk about right now, is that you're able to bring in economic context. So you're able to talk about economic context. So there's no sense in which you could do, economic context using Monte Carlo, right? Randomizing economic context wouldn't be very helpful. But there are disadvantages, right? So we only have so much history. We use 150 years of history. And so we're not considering return sequences that haven't occurred, but could. That also means certain asset classes, maybe the newer asset classes or more esoteric asset classes, you don't have as much data for. And sometimes people talk about the fact that those return sequences you're using, they have some overlap, right? So, January of 1960 will appear in all sorts of return sequences. So let's talk about economic context briefly and why that's helpful. And in Income Lab, no matter what analysis type you're using, you'll always have access to the historical analysis tab. So even if you're using Monte Carlo, traditional or regime-based, we will still run some historical analysis in order to be able to show you this picture. So this picture shows you for this particular plan with all its idiosyncrasies, the Social Security it has, the timing, maybe it's using the retirement smile, everything, what someone following this plan could have had an income at every point in recorded history for which we know that, right? So for any situation where we know what their experience would have been. So we can look back at the 1960s and say, hey, if someone was living out a 30-year retirement after 1965, what could they have spent? And we know that because we know what happened after 1965, right? Well, clearly that just getting that number requires historical data, but also we shade this graph to be blue and gray, blue being periods that are most like today in economic terms, gray being those least like today. And in order to do that shading, we consume a lot of data at Income Lab. And so we bring in all sorts of economic data to kind of produce that shading for you. So you can see at the bottom, we're using inflation and treasury rates and unemployment and CAPE and average investor equity allocation and the yield curve and so on to kind of build this composite picture of, hey, what do all these periods look like and which ones we're most like today? So because even if you're using Monte Carlo, you may want to talk about this with clients, we always do that for you, even if you're using Monte Carlo. So how could you use economic context? There's at least two ways. One is you could use it to kind of actually affect your income advice to people. So when income risk seems particularly high or low, tilting your advice up or down. I guess actually it'd be the reverse of that. So down when it's high, up when it's low. Another would be to enrich your client communication. So helping clients kind of understand the connections or lack thereof between economics and retirement income. And of course, you could do both as well. If you were allowing it to affect the advice you give, you'd be basically relying on the sort of patterns that we see from certain economic factors to income outcomes of a certain sort. So this is probably the most commonly discussed economic indicator with respect to retirement income, which is CAPE, so cyclically adjusted PE. And I've just picked out the relationship between CAPE and 20-year withdrawal rate. So very simplified, just saying, okay, we're gonna withdraw an inflation-adjusted amount for 20 years. How much could I take? And again, using history, because that's the only way to do it, using economic context. And you can see there's a trend as CAPE is higher. Historically, people have been able to afford lower withdrawal rates, right? So if you allow economic context to be part of your income advice, this is what you're leveraging, right? You can also use it to help in communication. So I know recently some advisors have said, I've had clients asking me, hey, I'm really worried, right? Things have been so good in markets for so long, but geez, it seems like there's a lot of kind of turmoil in the world, and they start thinking about things like the Great Depression, right? So you can use this chart. Maybe you pick out the Wall Street crash of 1929 and say, well, look, this is what happened during the Great Depression, and if we apply your plan to it, this is what it would look like. And so we've taken that into account here, right? And you can see in this case, the black line, which is their proposed income, is actually below the worst that happened during the Great Depression. And so, could the future be worse than the past? Of course, but in a way, you've kind of the plan you're adopting here is Great Depression proof, at least as it played out historically. So that can be really useful for providing context for clients where statistical measures are not as insightful for them, right? Talking about things like probability of success or Monte Carlo analysis is not as something that you can connect with as easily. Turning now to Monte Carlo analysis, advantages and disadvantages, and I think depending on your opinions, sometimes you could say each of these is both an advantage and a disadvantage. So you can explore scenarios that have never occurred. But of course, you might be exploring extreme outliers that we might think maybe will never occur or would be very unlikely to occur. You can express opinions. That's something you can't do with history, but you can't connect economic context, as we just discussed. You can cover asset classes with short histories, but of course you have to have assumptions about how those will behave. But you can't really include all realistic market behavior factors like changing correlations, right? So pluses and minuses. And there's lots written about this. Derek has written quite a bit about pluses and minuses of Monte Carlo. So may have some comments there. Within Income Lab, we have two approaches, as we've already said. We have one with one set of capital market assumptions, and we have defaults for you there. We try very hard to make our default capital market assumptions very formulaic. So they're produced formulaically using historical averages. So this is not, Income Lab's opinion about what your capital market assumption should be. We just want you to have very reasonable defaults available for use. And this is, this production of defaults is very similar to what you might find in other Monte Carlo based analyses. For regime-based, this is a place where, to my knowledge, we're unique that we have regime-based Monte Carlo. And again, you have a near-term and a long-term. Our defaults, again, they're formulaic, but it's a fairly sophisticated approach. What we do is we take history, we create rolling 30-year periods, and we exclude 2/3 of them, the ones that are least like today. And then we do averages. So averages for the first 10 years, averages for the following 20 years to create near-term and long-term. And so you'll see what typically happens there is, maybe near-term returns are lower, and then long-term returns are higher, right? And in a sort of reversion to the mean type pattern. Again, though, this is not the Income Lab opinion or anything. It's just a formulaic way to produce defaults. One thing that this can help with, depending on where you source your capital market assumptions, they're not always made for retirement income planning, right? They might be something more like 5 or 10 year capital market assumptions for investment planning. So it's important to think about kind of what the time scale, the intended time scale is for those capital market assumptions, because different plans are of different length, but it's very common to be planning for 20, 30, 40 years. And so maybe a shorter term or medium term capital market assumption set, applying that to 30 years may be problematic. So within the platform, within Income Lab, if you go into your settings and then click capital market assumptions, this menu is just reworked slightly to make it a little clearer. You'll find the capital market assumptions section. If you are the firm admin, you have an option to allow other advisors in the firm to edit their own capital market assumptions. You could uncheck this if you have firm assumptions that you are applying everywhere. And then you have 3 sets of capital market assumptions: traditional, regime-based near-term, and regime-based long-term. And for each of these, you can either use the defaults, which we provide, or change this toggle to custom, and you're able to input your own. Again, for regime-based Monte Carlo, you have 2 sets, one for the beginning of the plan, one for after that. And you can, under the regime-based near-term tab, if you hit custom, you can change how long the near-term assumptions apply. So our default is for 10 years, but you can adjust that, and long-term will apply for any period after that. Okay, so that's a lot about kind of where these analysis types come from, the kind of inputs, but really what's the purpose of this? What are we after, right? It's not, we're just really interested in math and we want to talk about math with our clients or something, right? There's a purpose of this, which is to provide good advice. So one answer to that question, what's the purpose of analysis types or capital market assumptions, is, well, we want to get a picture of the future that clients might be living through, right? We want to paint kind of the landscape that they're traveling through as realistically as we possibly can. And so we take the analysis types, the CMAs, actuarial data, which here would just be giving us the plan length, and all those household particulars. And we want to figure out, what kind of income risk do income levels have, and so on. So we're producing, again, this is still kind of, deep math and things we probably wouldn't show clients, but we're producing this picture of the world where, okay, there are different income levels that they might be able to access in their retirement, and each has its own level of risk, and we're estimating what levels of risk are there, right? So all of that randomization or using history and standard deviations and so on, that the purpose of that is to figure out a picture of income and income risk, and ultimately to provide as much as possible data that is at the right level of abstraction, as Derek has talked about, a level where our clients can access kind of a connection with that as easily as possible. So, for example, the proposed income and the income adjustment plan, all stated in dollar terms, right? Something that's very easy to connect with. Well, everything we just talked about with analysis types and the pluses and minuses of each and so on, those are behind these numbers, right? But these numbers are now simplified and presented in a straightforward way. Also, they provide things like the plan test, what could this plan feel like if followed over time, right? Might we expect to spend more or less than expected? How often might we have increases or decreases, and so on? So everything we just went over is behind this, and it's important to keep in mind that that's kind of the purpose of making choices about analysis types, capital market assumptions, and so on, is to get to these outputs that can be useful for client communication and for good planning. So that's the presentation I have so far. I imagine that there are a bunch of questions, but before we get there, maybe if Derek, if you have any kind of comments on making these kinds of decisions or talking with clients.
Yeah, no, I think for me, just having the ability to dive deeper if I need to, and understand what I'm doing as an advisor and why I'm doing that, is really powerful. Using a tool like Regime-Based Monte Carlo, I think that's a really neat thing to do. But then in practice, am I actually talking to most clients about that? No, probably not. It is really finding the right situation. I can go deeper if I need to with the right type of client that has questions about that. But for most of my clients, this isn't what's on their mind. I mean, the kind of the guardrails presentation that you can see there in terms of the current spending level, when the adjustments are going to occur, that's really where our conversation is focused. And then making sure that lines up in terms of the long-term income outcomes that somebody could experience, lines up with what they actually want. So I'd say today's presentation is much more for the advisor, and how we do what we do and do it well, even though it may not actually make it into some of the conversation. Although I think Justin provided a number of good ways that you could have some conversations around specific issues and education for clients on those. But yeah, for me, the most part, this is living in the background.
All right, guys. Got a few questions in here. Okay, so first one, how many asset classes? I guess if you guys can comment on how many asset classes should be used for capital market assumptions. The question is if you could comment on whether including too many asset classes increases the likelihood of model risk, or if it's better to use a few common major asset classes, like large cap, mid cap, small cap, etc.
So I can answer the first section, first set there. So again, this has been slightly redesigned. So I believe there are 15 asset classes right now. If you include inflation, we are actually in the process of expanding that. So there will be an all cap, value and growth, as well as 3 mid caps, so mid cap plus value and growth. I believe we have a short-term bond coming in. And there may be one other, commodities, I think. So those, that's in the process, as many of you have asked for more asset classes here. On the second comment on whether it increases model risk or not, Derek might have ideas on this. I do think on historical, we're very careful to use asset classes where we think we have enough history that historical analysis still works. And that's maybe frustrating to some users who would like to see newer asset classes. That doesn't mean we never would include those, but we are, as we expand these, we're trying to make sure everything works in all of the available analysis types. And so one worry I would have is if you don't have enough history to paint a reasonable picture. I think on the second point, it sort of depends on what sorts of portfolios you're putting together. You could even do a little bit of a A/B testing and see how much of an effect it has on the the outcomes that you're. Like I said, model risk is really there if it affects your decisions, right? And if it could have an adverse outcome. So if it's if the difference in income is $10 or something, probably it's not a big model risk. I don't know, Derek. I know you've done a lot of work on Monte Carlo. If you have thoughts there.
It's an interesting question. I'm kind of just answering from intuition and not necessarily as well grounded in a research response as I normally would like to be. But I think my initial reaction is that it does kind of depend on what sort of portfolios you're building. If you're putting in a lot of different asset classes, but things are pretty spread out across them, they're not really concentrated, then I don't think I would be as worried. But if you're modeling or using portfolios such that, there is this really broken out granular asset class selection, and then you're putting, I'm just making up an example, let's say you're putting 50% in small cap value or something, to me, then you might elevate your risk of just getting some historical anomaly and putting too much weight on that. But if you have a pretty well diversified across the asset classes, then I don't. So I do think it is how you're using it. The more heavily weighted you are in a small number of granular categories, the more concerned I would potentially be. But yeah, that comes down to more how you use it.
And this is just a quick one in the chat. Is there a life insurance asset class?
No, there's not. You can put life insurance in as kind of a protection or a cash value, but no, all the asset classes are just, well, I switched what you're looking at so you can see them here.
Yeah, and so the next one, this one's gotten a few upvotes. So how does Income Lab account for historic low interest rates at the beginning of the first regime? And do rising interest rates show as negative returns in bonds, i.e. do you illustrate sequence risk in bonds?
Yeah, so I can show you kind of, these are the, well, I'm not in the production environment, so hopefully these are the updated numbers, but if they're not, they're close. Yeah, it looks like they're pretty close. So you can see, again, this is formulaic, so this isn't, Justin Fitzpatrick's opinion or something. Very low bond return assumptions for the near term, and then if we get to the long term, they're going up, although still not, spectacularly, although, you can see that standard deviations would certainly allow for some high returns some years. So that actually, when I first saw that come out, that was, long before interest rates went up so much, I was surprised, but again, that's just a formulaic thing. And we have a kind of a filter on this where our defaults won't be negative. That's just an assumption. You're welcome to put negative returns in here as your capital market assumptions if you want. So I think that the formula actually spit out some negative returns for bonds, but there's a floor, I guess you could say, on what we'll put in as a default.
Okay. And then next question, to what degree is CAPE ratio used in making capital market assumptions? Shiller had been saying from 2012 to 21 that CAPE was at historic high. In 2021, he acquiesced and said that high CAPE was justified in a low rate world, which has led some people to suggest that random walk may be a better model than CAPE with respect to estimating future market returns. So I guess, can you guys speak more about, what degree is CAPE ratio used in making CMAs?
Yeah, so it's basically up to you how much you want to use that or not. I would say, again, in our formula for producing defaults, it is used, but it's not the only thing that's used. So I can go back to that slide. Okay, so these are the 7 things we're using to produce this blue and gray picture. So it's always tempting to take economic data, run a regression on it, produce a formula, and have that tell you how much income to take. I think that's a very dangerous game to play, at least, unless you have a lot of confidence in your formula. And so rather than go that approach, we've chosen to allow you to use economic context, both for communication and for tilting your advice, but doing it in kind of almost an agnostic approach to how this will work. So there's no formula within Income Lab that says if CAPE is high, then push income down. There's just nowhere in the code that says that. What you see here is what really happens if you're applying economic context, which it says, okay, I'm going to use history, but I'm not going to use the gray stuff, right? And the gray stuff is just things that are less like today. And it just happens that those are by and large periods where you could have had high income, but there's nowhere where we say, hey, exclude the high income stuff. So it's that sort of just falls out of this concept of economic proximity. And what we're trying to do there is acknowledge that really this is not a perfect science. There's no formula that will tell you based on what CAPE is or what interest rates are, how much you can spend. It's more like a tilt. If you want to do that in your advice, you don't have to. You can choose not to apply this at all. So I hope that helps. I don't know,
yeah.
Derek.
And Justin, Derek, before you answer, go ahead and stay on this screen. We have a few more questions on this particular screen. Derek.
Yeah, we can go ahead and jump to the next question. I didn't really have much to add beyond what Justin already said.
Perfect. Okay. Yeah. So now, regarding the economic context screen, is that comparing whether any adjustments are necessary or whether the plan fails completely, even with adjustments? So that is, if the proposed income line is below the Great Depression, does that mean the client would have had to make any adjustments during that time period, or that their plan would survive as long as adjustments were made?
So it's extremely rare. I mean, I can think of some odd plans that I could make fail even with adjustments, but most of the time adjustments would save any plan. So what you're seeing here is because it's history, we know the outcome, right? So it's saying this is the most you could have spent with this plan at this point in your life, and never had to make an adjustment, right? So it's trying to be a very, it's like a static snapshot of a point in your life. However, the black line here you can see is slightly above kind of the early 20th century. So you would be saying, okay, if you spent at that level of just under $15,000, you would have had to adjust down if this were the early part of the 20th century. That is a way to interpret this. Whereas if the if the mountains are above that black line, it's saying, well, in actuality, you wouldn't have had to adjust down if that were the period you were living through. Of course, you wouldn't have known that until the end of till the end of your plan, but that's what it's telling you.
And then next one is, can you explain more about how you find similar historical scenarios? Do you look at multiple factors? How much weight do you give to the different factors?
Yeah, so we use the 7 things you see here, and then we weight them according to their to basically their importance, their power in giving you insight into how much income you can spend historically. So we use something called R squared, which gives you kind of the well, I'm probably getting into trouble if I use the wrong words here. I want to say predictive power, explanatory power is probably the correct way to put it, of each of these factors. So, in any period where all 7 are available, it may be that treasury rates are, less predictive or less explanatory than CAPE. And so CAPE will have a slightly higher weighting in building this picture. But again, the goal is just this kind of gross level picture of, hey, what parts of time were a little more like today and what parts were less like today. And so in a way because we're not looking for a formula that produces a specific income based on these inputs, that approach sort of that works.
And the next one is, how was the period that shows on the economic context screen determined? Is it based on the age of the client, date of retirement? Can you just explain more about?
So it's using the current plan length. So which is based on ages and longevity settings. So if that plan length is 25 years, then what you're seeing here is the incomes at this point of time for a plan that was 25 years long. One thing on the economic or the historical analysis chart that sometimes trips people up is the most recent date you'll see here is one that was a plan length ago, right? So if 25 years, then it would be 25 years ago. This month is the most recent one you would see.
And now to some other topics of questions. So using the cash reserve or bucket strategy for cash flow needs, how does Income Lab incorporate and analyze this method for retirement cash flow needs?
Let me think a little bit about that. You know, there are so many bucket strategies. I guess I might have to know what kind of approach you mean to think about it. But by and large, what's being analyzed here is kind of a total return picture, right? So it'll look at the entire portfolio. If you've got a lot in cash, that'll have an effect on both the income proposal and the guardrails.
And I can jump in and answer, or at least address this from how I use a bucket strategy. So I'm a big fan of, and Michael Kitces has written about using a bucket strategy more as a psychological tool rather than even, I mean, you could use it if you're you could start to spend down that, the bucket. But so that's kind of my personal approach. So I'm often talking about buckets and showing my clients buckets. And if somebody does have a particularly large cash holding or something, I can reflect that in the portfolio assumption, the information that I'm putting in about the portfolio. But generally speaking, it's not actually modeling. To my understanding, there's no way to actually show it modeling, like spending down that bucket first and then moving on. It's just going to be spending from the total portfolio. Is that correct, Justin?
That's right. Yep.
And Lauren, if you have any follow-up questions, feel free to chat me and I can kind of promote you if we need to kind of get more explanation. But to the next question is, so this is to the tax center, is just, can you explain the break-even analysis in the tax center?
Sure. So that's just the point at which the cumulative estimated taxes for so you have two approaches, right? A and B, or 1 and 2. So that's just the point at which the taxes paid for the second are lower than the first. So cumulatively. So kind of more practically speaking, you might be looking at Roth conversion strategies because they are estimated to save you money on taxes over time. But you might wonder, well, how long will I have to live for that to be estimated to have worked, right? Ripping the Band-Aid off on taxes might mean high taxes in the first couple of years. How long will it take me to make up for that? It's kind of similar to the Social Security break even, right? It's like, well, if I'm giving up something now, how long is it going to take for me to have decided that was a good idea? So it's just cumulative taxes in strategy 1 versus strategy 2.
Okay. And then this next one, let me see if I can understand. We may have to have them come and explain a little more. It says, how would you suggest the placement of the current guardrails?
I think a good way to think about it is what guardrail positioning produces both short-term guardrails and plan test results that are comfortable to the client. And so, if this is a more risk-averse client, you might want that, especially that income decrease guardrail to be, farther away from their current position, right? So, in this case, that's a pretty good drop in their portfolio. Maybe that's comfortable to them. And then you also want to look at the plan test and ask, on an overall basis and kind of on a cadence of adjustments and size of adjustments, are these the sorts of things that the client feels comfortable with? And so you can use, the preset, the defaults, which are here just, to make things easy for you, explore different settings here. There are 9 preset settings, or if you really want to dive in, you can get into the advanced settings and specify them more exactly. But I'd say those are the 2 places where I would look, kind of the short-term view, and then the longer-term plan test view. Is this a comfortable, world for the client to live in? Derek, do you have any tips there?
No, I think you got it exactly right in terms of you really do want to look at that long-term income experience, make sure that aligns with the types of adjustments somebody would want to make, right? If they're somebody who's going to say, I really don't want to be making downward adjustments, I'm willing to give up some upside to do that, then you're going to lean more towards the conservative side of the income setting adjustments. And, for me too, I guess there is another factor that I'm often looking at that's also, kind of the risk capacity, I guess, but in an income perspective where, some clients, they given, if they're really diligent savers, they're not spending anywhere near as high, they have that ability to use a more conservative strategy if they would like to. Whereas other clients, I may not even, push them so much to that option, and instead frame the conversation around, here's the type of adjustments that, historically you would need to be willing to make your income, your desired income work. And so I do kind of filter it through that. And when I run the initial plan, I like to get at least an income target of some kind after tax that a client's shooting for, and then, have that conversation from there. If they're right on with kind of the middle of the road level, then maybe talk through those types of long-term income experience and see if that's a good fit, and then just go from there. If the target is their personal target is way below what the middle of the road approach would say they could spend, then I could bump them down to conservative and have more of that conversation about where do they feel best. But it does lean on, I think, kind of those 2 different factors.
Gotcha. And this was kind of a clarification on the question. It was how would you suggest we explain the placement of the guardrails to a client?
I personally tend to stay away from inviting conversation on that topic in terms of what's really behind the scenes, driving that. Of course, I can have that conversation if it's an engineer or somebody that really is digging into the details and wants to know. But for the most part, I'm talking more in general terms. This is a more conservative strategy. This is a more aggressive strategy that would mean bigger adjustments, but more income now. And really just trying to keep the conversation there. And I think intuitively, most people grasp that they could take more income now with more risk of adjustment. And that's where I'm framing most of my conversation.
Okay. And Justin, while you're on this page, this one is real quick. Where can you see what CMAs are being used in your household analysis?
So that's a great question. If you go to advanced settings, plan analysis, you've got this historical. If you go to default values, you can set what your default is. So any new plan, any new household, this will be the setting. You can always go and change that. So if you say, well, I've got my regime-based Monte Carlo CMAs, I've got my process for that, that's what I want to use, you could set it here. And then any new plan you create will use that. Keep in mind, anything you've already created, we won't overwrite that. Generally we don't want to make changes behind the scenes that you're not aware of. So this is, the default values are only for, future things you create. If you want to change them on existing plans, you want to go to the advanced settings.
And then this next one, I'll throw it out there, but I may kind of say it may be best for us to schedule a meeting directly to kind of talk through the scenario. But the question is, help me understand how an income of $4,157 per month only has a tax rate of 6%. Meaning the after-tax income is $13,281. So I think the question is our cash flow enough to pay all the taxes? Or I think maybe helping them understand kind of why the tax rate is potentially so low with their before and after tax amount.
Yeah, I mean, I'd have to see all the cash flows that are in the plan to know for sure. But certainly there's a certain amount of income that is tax free for anybody, right? Even if it's just because of your standard deduction. But there may be other, return of basis. Could be Roth distributions, all sorts of things, and that's in the denominator, right? So we're doing total taxes over total income, and so those could be parts of it.
I think one point, or just quick clarification, I think they're actually talking about this scenario up on the screen. So explaining
Okay.
the before and after taxes here.
I'm glad you pointed that out, Derek. My Q&A was covering that.
All right, we can dive in and take a quick look. Yeah, so it looks like the way that this is put together, there's a bunch of non-taxable income. This is just a random example household, so I do not recall what I put in here, but you can see, even the taxable Social Security takes a while to get above into the 10% bracket. So I'm sure that's what's going on there.
Okay. We've got about 6 more, so I'll just kind of keep going through these. Is there a tutorial or video of how kind of this would be presented to a client? I could potentially answer that. Our next webinar will kind of just talk more about how to have this conversation and kind of present Income Lab to clients. So I think for Keith, we don't have a specific tutorial video, but I think our next webinar next week, Tuesday, would actually kind of help answer and give you more background there on how kind of Derek more specifically is even having this conversation with clients. Is that a fair answer? Or do you guys have anything else to add? Perfect. I will consider that one done. Okay. So from there, so kind of back to more modeling. How would you suggest modeling portfolios that use alternative assets like gold, managed futures, private equity, et cetera? So imagine that's 20 to 30% of the total portfolio inside the software. And then, how would you model replacing that portion of the portfolio? With what? How much? Oh, I guess if we don't have that, kind of what portion of the portfolio would you kind of replace to factor those in?
Yeah, I mean, this is always, I guess not technically correct usage, but I always think of this as like basis risk, almost like, right? You have to choose something to, in this case, model the world with, and then you have an actual investment, right? So sort of like if you're doing hedging, you have, your derivatives and your actual thing. Like, what's the connection? Are they going to move in the same direction? Are they going to behave in the same way? So it's, choosing from the asset classes available, which ones you think are, in the case, I guess, best, least bad as a way to model that. I think the expansion of asset classes is going to help that some, but there are asset classes always that won't have an exact mix there. Derek, I'm sure that's a common issue, not just with Income Lab, but lots of software programs. Have you heard other takes on it?
I mean, to me, that's about as good as you can do, right? Is just trying to find the best alternative and realize it's not perfect, but also, at the end of the day, none of this is perfect. We know that it's not, it's a tool, and understanding the limitations of the tool and how you use it with your client. I wouldn't personally be afraid of using a tool just because it doesn't perfectly match the asset classes. I'd just be cognizant of that and realize that as your guardrails get updated at the end of the day, that's still going to be the most important thing in terms of how to adjust that spending.
Guys, next question. Does the program assume a constant asset allocation throughout pre-retirement and post-retirement? Or is there a way to account for the fact that, as they approach retirement, the clients may be reducing their equity allocation?
That's a great question. It is a constant asset allocation, but that is a feature that many people have asked for, and so it is something that we're looking at adding. And so really the main question is for us in adding that feature, how best to cover as many possible use cases as possible, right? because there may be lots of ways that people would want to model that, whether it's glide paths or changes at a particular point in time and so on.
And then how do reverse mortgages, life insurance loans, and inheritances fit into Income Lab outputs?
Yeah, so mostly you're going to want to put those in as cash flows under other income. So, I could put in inheritance, I guess, is a little tricky because you do have to put a date. And I even misspelled that. So I'd do that one time, be a little bit conservative maybe on the date. And we could call that non-taxable, right? Same sort of thing with reverse mortgages, but there you'd be looking at a recurring cash flow.
And is a FIRE client, so I'm assuming it's financial independence, retire early client, able to be modeled in Income Lab?
Sure, absolutely. Yep. Just using their ages or their dates of birth, and the longevity settings will adapt to that, and they'll have a very long plan.
Perfect. Awesome. And this last one is not really a question, but just feedback. And it's one of our users said, my big attraction to Income Lab is that it seems to be the first and best tool for implementing dynamic distributions. And thank you. Always love the feedback. So yeah, we really appreciate that. And then any last questions? We have a few more minutes here, so we probably have time for one more. I will see if something comes into the queue. Okay. Well, Justin, Derek, again, guys, thank you so much. Excited for this next year of webinars and amazing topics to come. For our users, thanks for joining. I will send out the recording so folks can view other later, and we will have another webinar next Tuesday, and we'll kind of let folks know about our upcoming webinars in February and March. Outside of that, for anyone who has kind of specific scenarios or questions that you want to help with, please reach out to your account manager or to our team, and we're more than happy to hop on a Zoom and kind of review any specific scenarios, or just help out with any questions that come up as well. And with that, guys, thanks again, and I will go ahead and close the webinar. Have a good day, everyone.
Bye-bye.
Bye.